Okay.
If they haven't used a line where the $42,000 balance come from, you're just saying that's what's available is $987,000. If they haven't used it, then there should be no balance on the line, right?
No, because what they did in this case was rolled in the closing costs.
Okay.
So they use the equity, they create a loan balance based on the closing costs, which was probably $6,000 or something. And so every year, every month, you're being charged on that $10,000, and that's how you get to that $42,000. Does that make sense?
It certainly does. Are those fees income tax? Yep. Are those fees income tax deductible?
No, the only part of the fees that may be income tax deductible with any type of loan is if you pay points. And normally in this day and age, you don't pay points. It's called an origination fee.
Right.
So if they do charge an origination fee, those are tax deductible. I'm not a tax expert, I have to say that. But that's normally with any type of loan that you do is tax deductible.
I guess what I was thinking, just where their line of credit is at 987 and the value is at 933. So
that's the 40.
Had taken that 987,000 out, and the house is going to the creditor, their heirs don't have to worry about the difference between what the line of credit.
The 987.
Right.
Right. So, you're the heirs and you can kind of forecast. I mean, this is just off the cuff, but let's just say, okay, the heirs know that their mother or father is going to die within 10 days. They can go in and tap out that whole 987 if they wanted to. And then they pass away, their only concern is the 933, not the difference.
Right.
Okay. But
the FHA would be making up the difference for the creditor, right?
Yeah, the 50 something thousand.
Right.
Yeah. But, and that's a good question because they are paying for this. Now, a portion of their rate has a percentage that's going to FHA every month, and that's 1.25%. So part of their interest payment that they make, 1.25% of it goes to FHA for this in case this does happen. It rarely happens this way. Because a lot of times they start digging into, there's long-term, like we talked about, there's long-term care needs, things of that nature. But if it does happen, then it is there for them. Does that all make sense?
Yes.
And it's tax-free. What's important is any monies you take from your line of credit, it's tax-free money. Okay? So, Nicole, I don't know if you're familiar with Wade Pfau.
You're reading his book right now.
Sure.
Oh, you are his new one?
Yeah.
Okay. Yeah, he's PhD, CFA. He was actually, back in the day, very against reverse mortgages until they retuned it. Now he's done like thousands of Monte Carlo simulations. He's done case studies for the FPA journal and so forth. That's kind of who I emulate, kind of his strategies. And he talks about a passive strategy and a coordinated strategy. In a passive strategy, in the past, it was a loan of last resort, meaning you flow through your portfolio until it's exhausted, and then you put it on a reverse mortgage. Now he's kind of redirected it, especially with all the simulations he's done, and he's created a kind of coordinated active strategy. And that's what we're going to be talking about next. Okay? So in this case study, the no HECM strategy, meaning that it's a loan of last resort. You go through the portfolio, then you get the lump sum from your home, and you go through that. And right now, in this case, based on a 32-year investment return, it's a 35% cash flow survival rate at a 6.5% withdrawal rate.
Right.
And I don't know what's the common one? Is it still 4%? Is it higher now? Is it now up to 6, 7?
No.
What is
3.5?
3.5?
Yeah. If you want, yes, if you want a 90% or a better survival rate, the most you can take out of your portfolio is 3.5% a year.
Wow, that's amazing. Okay. So in the passive strategy, so the no HECM is, what he means by that is, I'm sorry, that you never put in you never did a reverse mortgage. And they have a 35% at 6.5. On a conventional passive strategy, that means, you go through your portfolio. When that's done, then you put in a line of a HECM, home equity conversion mortgage, and you have a 55%. And then you talked about a coordinated strategy, you have an 85%. And we'll talk about that in the next slide. So here's a case study based on a passive strategy, meaning what they did was they just went through their IRA and then did a reverse mortgage at the end. Okay?
Right.
So what we have here is the investment is $1.2 million, and every year they just went through at a 77% disbursement rate. And after 16 years, they're left with $102,000. And then at that point, maybe they would think about doing a reverse mortgage.
Yep, because they're out of money.
78 years old. Okay. And you know what, Nicole? You may already be doing this, maybe with whole life cash value, things of this nature.
Yep.
But this is another way to utilize it in case that's not in place. So,
sure.
So at that time at 78, obviously their home value is worth a lot more, and then they can tap into that, but they only have 102 left in their portfolio. So does this slide make sense?
Yep, absolutely.
Okay. Okay. So we go to the coordinated strategy. So in this case, they start out with 1.2 million, distribution of 7%. In that case, they're taking out roughly 100,800, and it's more because there's tax implications, right?
Absolutely.
So in this case, that's their distribution every year. But in the down years, they flip over and they turn on their line of credit. And they have to take less out because it's tax-free. So they only take out $84,000. And they only do that 4 times in the 16-year period. And just by doing that in a 16-year period 4 times, at 78, the portfolio is still at $1.1 million. Okay? And they still have, their available credit line is a little bit less, $127,000. But it's much better having that portfolio at 1.1 than doing a reverse mortgage at maybe you may be able to get 400,000, 300,000.
So you've got compounding working for you twice.
Yes. So you have the loan, the available line of credit is growing every year, even though they just used it 4 times. Whatever they're not using is still growing.
Sure.
And it doesn't matter. It's like placing a put on your home equity, meaning that it doesn't matter what the market is doing out there. It doesn't matter if 2007 hits again and all the values go down. That line of credit will grow guaranteed by the rate of interest you're being charged, no matter what the market is doing. So you're putting in place an ultimate safety net. And if they use it, great. You can use it in this coordinated type strategy for portfolio longevity and so forth. Or you can just use it as a safety net for down the road. If you don't use it, fine. But it's there. It's in place. And it's in place for life.
The reason I asked about the income tax deduction for the origination fees is if they paid that, in this example, let's call it $6,000. If they paid that $6,000 from another source and it truly had a zero balance, then they're not being charged the 1.5%, but it's still growing by, in our example, 5%, right?
Correct. You bring up a good point. This is a pay optional loan. I have some borrowers out there that their required distributions are so high that they don't need the money.
Right.
So they actually take the money and apply it, the interest, to keep the equity position in place. And if you do that, you'll still get a 1098 at the end of the year to help offset those high distributions. So sometimes they choose to do that. Now, the one thing to keep in mind with this is you don't want to pay this down to zero, because FHA will come in and close a line of credit and hand you the deed to your home. So you always want to keep a certain amount of unpaid balance or loan balance, maybe 1,000, 1,500. Okay.
Yep.